From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro as we see possibly the first up week in 4 weeks. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue. Has bad news officially become good news?
We're probably in a slow patch.
It's going to be really difficult for the Fed to hike rates aggressively.
If supply side prices slow with demand, then the Fed is likely to back off.
We're seeing the market sort of shrug off some of the hawkish data.
Basically, will be one of a recession by the end of this year.
A more shallow recessionary scenario.
It's probably coming in the second half.
A shallow recession.
We're doing things in the present based on backward-looking data.
The fundamentals still remain quite strong.
It's still not too late to try and get, your position for kind of wealth preservation.
It's a space that we're looking at very closely and are thinking of going back to the long side fairly soon.
Investors that I'm talking to, they're starting to get back into the markets, and that's a relatively good sign.
It's a muddle of potential Fed policy in the face of a slowing economy. Joining us now to discuss, Invesco's Rob Waldner and Ella Hoxha of Pictet Asset Management. Ella, what's your view on why we've seen bonds rally this week in the face of the R call and this expectation for a hawkish Fed?
Well, we've had an aggressive repricing in rates this year, probably the worst start to first half of a year in probably as long as we can recall, 1700s, some are saying. So probably due a respite, given position had gotten very, very short on both US and European side. So, it's normal to expect some sort of retracement from that. That's more on the sort of technical market side. On the economic side, we've been seeing signs of a slowdown in the US and also elsewhere in the world. And so that's probably causing some jitters with regards to this, hawkish Fed and slowing economy. We've not really seen that happen before. And so making markets nervous and therefore giving bonds a bit of a bid here.
So, Rob, have we seen peak yields?
I think we have, Lisa. I think we're in a situation where it was higher inflation that drove bond yields higher for the first part of this year. That's over. We think now it's about growth and financial conditions. And, growth, everything I look at in growth is slowing. So whether you look at PMIs, you look at inventories, you look at a housing market, it's all slowing, and financial conditions have tightened quite a bit, whether it's mortgage rates, M2, money supply. It's all telling you that the economy is slowing. So if we're now in an environment where it's about growth and financial conditions, it makes sense for the bond market to peak out here. And we think there's value in bonds, particularly in high quality credit bonds.
New York Fed President Jim Bullard, I should say St. Louis Fed President Jim Bullard speaking at a panel earlier today. Take a listen. I think that we are working on that, Sap, but he was talking about front-loading rate hikes and how we're going to end up with a perhaps peaking out at 3.5% Fed funds rate, sort of like what we're seeing being priced into the market right now. Ella, do you agree with what we just heard from Rob, that we've seen peak yields, that we've seen a softening? The Fed is going to be aggressive, but they will be able to follow that up with rate cuts.
It's possible that we've seen a peak. We're not entirely convinced yet, and the reason for that is we still don't have strong visibility on the inflation side. As we've seen, those numbers have been pretty sticky for quite some time. So that's one thing. And then the other thing is the Fed seems to be pretty keen on tightening policy here. And with wages picking up significantly here, it's very difficult for them to pull back right away. So we don't think this tug of war is over for markets, but we do agree on one thing, that there is some value now appearing in treasuries. And certainly the belly has been showing that. So the 5 to 10 year part of the curve has been giving you some signals to that effect, but it's by no means over.
Yeah. Well, Rob, what's your sense about whether bad news is good news at this point when it comes to riskier securities within the credit sphere, within even equities?
Well, I think that that bad news, good news narrative is one that involves the Fed and financial conditions. And what worries me is the Fed is firmly locked into moving interest rates based on trailing data. I mean, we're going to get this Michigan inflation expectations out later today. I think that's kind of really a moving average of past inflation. So not only are we looking backwards at inflation, we're looking at a moving average of inflation. And the Fed seems to be indicating that that's what's going to be the driver of their policy. And that makes me very concerned because, bad news could be bad news in that scenario because the Fed may not react to that bad news. It may not give us some relief. So that's why I say, you want to be in higher quality, you want fixed income, and you want to be in higher quality fixed income probably because that's where you can get through this sort of bad news is bad news kind of scenario.
And that's certainly what we're hearing from Chair Powell, his commitment not giving much comfort as weak data continues to roll in.
It's unconditional, our commitment is. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment.
Bloomberg's Michael McKee joins us now for more, and we were talking earlier about that 10 a.m. data dump that could be bad news being bad news.
Well, it's an update of what the Fed saw earlier this month, so it may not be decisive for them, but they will keep watching it into the coming months. But here's the interesting thing. The economy is doing what the Fed asked it to do. It's slowing down. The bond market, the one marshmallow folks in the bond market are doing this instead. They're thinking the Fed's going to go too far, that they're repricing already for recession. Now, it's interesting because the white line is where we are now. The blue line is where we were on Fed Day, and you can see how far, especially the short end, has come down. But they're still above what the Fed considers to be neutral, around 3%. So they're still pricing in some tightening. They just think that it might end a little badly. There are some reasons for concern. Jim Bullard was very optimistic this morning, saying he thinks the economy can get through this just fine, and we're at the beginning of a long expansion. But Adam Tooze at Columbia University put together this list of hangovers, potential crises that we could still face over the next year. You can see same suspects: COVID, the energy crisis, stagflation, hunger. They worry about sovereign debt crises because of course, what's going on around the world in emerging markets. And then you got Italy and the war, and then we've got an election this fall. So a lot of factors still out there that are outside the Fed's control that could lead to that recession scenario. But here's the thing that worries people the most. The fear of recession can be self-fulfilling. Look at the number of newspaper stories talking about recession, and then you see the University of Michigan's Consumer Sentiment Index, consumer sentiment plunging as recession talk rises. We might talk ourselves into it if none of those other bad things happen. But at this point, the Fed is betting on something a little bit better, but we got to see. And
Michael McKee will be watching for that today, and perhaps that 10 a.m. number will change the conversation. Still with us, Rob Waldner and Ella Hoxha. Rob, I want to get your sense on the yield curve and what it's signaling currently. We are looking at an increasingly flat yield curve, but sort of a stasis, right? I mean, we've really had a calm this week. Are you still looking for a yield curve inversion? Is that the most likely path of travel?
If the Fed continues to be looking backward at inflation, I think that's probably what we will see because we have growing sense of slowing economic momentum. I think a peak in forward-looking inflation expectations from our perspective, but the actual data is going to remain high. And if the Fed continues to do 75 basis point hikes while we're doing that, that's going to invert the curve. I think that a great analogy here is the early 1990s, the early part of my career, when after the unification of Germany, we had a massive fiscal boom, much like we had here in the U.S. in this pandemic. And, the growth picked up, inflation picked up, and the Bundesbank got very aggressive with their monetary policy, and they really inverted the yield curve quite a bit. And I think if the Fed is backward looking and looking at inflation, that's the kind of model we could have here.
Meanwhile, you've got Bank of America talking about some of the fund flows. Michael Hartnett writing, quote, year to date, investors have bought $195 billion of stocks and sold $193 billion of bonds. 2022 capitulation has been in bonds and not stocks. Bank of America bull and bear indicator remains at maximum bearish level of 0. B of A global breadth rule contrarian buy signal triggered June 21st. Ella, has there been this sort of shift into your interest in stocks away from bonds, considering the peak capitulation there, and perhaps not so much in stocks?
Well, I'll talk with a macro head to that because obviously I'm a bond PM. So, we're not seeing that, certainly not on the flows. We're seeing some interest in quality bonds, so treasuries, as I was saying earlier, from our clients. But we're still seeing no interest really on the equity side or in the sort of riskier assets side. There's still quite a bit of liquidation going on. Now, for us, it's really, making the sort of the call to get really bullish here. You have to make some big calls on, one is inflation, and the second one for us is the Fed. So you got to believe that the Fed will be turning dovishly from here. And as I was saying earlier, given where the level of wages is and where inflation is, it's very difficult to get bulled up at this stage. So we're not convinced yet by this. Potentially we're at capitulation stage. Absolutely, we agree with that. But is this the time to actually buy the dip? We'll probably say no.
Ella Hoxha, Rob Waldner, both of you are sticking with us. Right now, we want to take a look at some of the stocks moving ahead of the opening bell. Here is Abigail Doolittle.
Well, Lisa, you were mentioning the fact that the futures, the indexes, the stock indexes here in the U.S. on pace for the first up week in 4, the best week since the last up week at the end of May. So the question is this the start of a bear market bounce? And if it is, we, of course, need big tech. Big tech is participating, Microsoft being one of those stocks, up 1.1%. This as they may, in fact, do that $40 billion debt deal to rebuild their cash. Twitter up about 0.4% on the news that Twitter has given Musk's team the live account details so that they can do some of the bot work. So folks optimistic on the idea that could help the deal go through. FedEx popping up 3.1%, a strong quarter, a good start for the new CEO. Higher freight rates lift the profits for the company and their outlook. And then finally, Alibaba, one of this week's big winners, up 2.8% on the day, on the week up 9% from the March lows, up 60%. Lisa, that of course is a $120 billion ad. All of this on the possibility of Ant Financial going public. Plus, it seems that Beijing is being a little bit more amicable for some of these tech stocks in terms of regulation. So a nice rally there for sure.
Yeah, perhaps easing up as they face off into economic weakness there. Abigail, thank you so much. Coming up, President Biden heading to Europe amid ongoing battles with energy costs.
The meeting was a productive dialogue focused on creating an opportunity for industry to work with government to help deliver needed relief to American consumers.
We'll take a look at that still ahead as oil very much the forefront of some of the moves this week, seeing a bit of weakness until today, where you are seeing a bit of a rebound just slightly on the heels of the supply-demand dynamic and not perhaps as much the recession call. We are seeing S&P futures climb ahead of the open, up 0.8%. Yields climbing to price down in the bond space. This is Bloomberg.
The meeting was a productive dialogue focused on creating an opportunity for industry to work with government to help deliver needed relief to American consumers. What Secretary Granholm has called on is for her team to continue having conversations with the oil companies.
The Energy Secretary's conversation with top oil executives yielding little progress on lowering prices at the pump. But President Biden turning his focus now abroad, heading to the G7 summit kicking off on Sunday. Bloomberg's Anne-Marie Hordern joining us now from Washington, D.C. What are we expecting to hear coming out of some of these G7 meetings and, frankly, just some of the conversations out of Riyadh as well?
Well, Lisa, you're really hitting the nail on the head when you think about setting that up between what Secretary Granholm had at a meeting yesterday with oil executives to the fact that the president is now going abroad, because this is a moment in time where foreign policy and domestic policy concerns are really converging. And of course, that is because the price of oil and the fact that it is going up, this premium we have, this geopolitical premium, is being exacerbated by Russia's invasion of Ukraine. So the first part, I would say, is some talks that potentially could have on the G7 when it comes to the president's most important and dire issue right now, which is inflation, is potentially a discussion, in the very least, about price caps on Russia. This is something that the Treasury Secretary Janet Yellen has spoken about before. How do you keep Russian crude on the market but make sure Russia is not increasing their revenues and their profit from that crude? So that's potentially something that's going to be discussed. And then, of course, Saudi Arabia, which is a trip he's going to take in July. obviously oil and the traditional exchange of security for oil will loom large, even though everyone I talk to, whether or not it's in the kingdom or in Washington, say that there's a lot about this relation and other pillars and deliverables that they will be discussing.
Anne-Marie, before you go, how important is it for the U.S. to have a leadership role when talking with European allies in terms of providing them with more gas and with more crude from the United States and helping them secure it elsewhere in order to continue pushing back against Russia?
Well, they've been doing this for months, and they've had those conversations, frankly, well before Russia's invasion of Ukraine. The U.S. officials were working alongside their European counterparts, making sure they can try to shore up liquefied natural gas instead of taking that natural gas through pipelines if it came to that point from Russia. The big issue for Europe, Lisa, which you know, is that when it comes to natural gas, less so with oil, it's really an infrastructure problem. Europe is built to be delivered with this natural gas via pipelines, while a lot of them are still struggling with LNG terminals. So really, this war has pivoted a lot of what you see going on in Europe, especially in Germany. They didn't have any LNG terminals, and now they're building two.
All right, Anne-Marie Hodurna in Washington, D.C., thank you so much. Ella Hoxha and Rob Waldner still with us. I would love to get your opinions. And Rob, I'll start with you about oil and how we did see it cool off this week and how much that was really a huge driver of some of the price action that we saw in the bond world.
Yeah, well, oil, I think it's important with energy to think about the near term and the longer term. In the near term, if I'm right and growth is slowing, then demand for energy will cool a bit. And, you know, you may be able to see a period of more stable energy prices, and that would also fit with inflation kind of, or the energy part of inflation stabilizing. But I do think we need to really, the policymakers need to get to grips with the medium-term issue, which is as the economy grows, it needs more energy, and we need to have a source for that energy. And we've been underinvesting in traditional fossil fuel energy sources for a number of years. And if we don't solve that problem in some way, either upping investment in traditional sources or finding or more alternative sources, this is going to be with us for quite a while. And so we need to think about this as a medium-term issue. It's really a policy, a longer-term, medium-term policy issue. And our policy's been, has been constraining investment, not supporting investment.
But Ella, putting policy aside for a moment, I'm just wondering about the price action in markets, because this week, all of a sudden, the gloom really pervaded the oil world in a way that it hadn't until now. It really had been a supply side story that was really not meeting demand. How much do you expect that to underpin some of the movement that we see in the bond world, considering the fact that all of a sudden that takes some of the pressure off?
Absolutely. We're seeing that reflected in the pricing, as you correctly point out. It's showing up in the break-evens. It's showing up in the five-year inflation swaps. So the market taking away quite a bit of that premium down, and all of that happening in the course of the past week or so. So, yeah, absolutely, I agree with the previous speaker in terms of, as you see oil prices coming down on the face of potentially weaker growth ahead of us. That makes sense that you shave some of those expectations off. But to us, that's obviously a positive driver for bonds, at least over the short term. But it's very difficult to see how much that contributes into inflation falling so substantially that the Fed has to back off from this very hawkish path. We're not convinced that we have enough evidence to that effect yet. And I bring back wages being very high here, and in terms of inflation expectations with consumers, et cetera, those are still elevated. So too early a time to tell.
Yeah, and just to bring you some headlines from some of the meetings being held in Europe on oil caps and on oil policy, the European Union's von der Leyen saying that U.S. LNG deliveries are up to the European Union are up 75% this year. And you have Mario Draghi talking about how talks on a cap to gas prices will resume after the summer. Ella, but to your point, and this is really important, how much is the volatility in oil prices driving volatility in bond prices and creating a really confusing signal that may be a bit divorced from what the fundamental narrative should be?
It's one factor. It's not the only factor, but it's been an important one. But let's, I probably would quote Powell here and say that there was inflation before we even started this conflict in Ukraine and sort of exacerbated the issue. So, and that's coming also from food prices, not helped from the conflict, but also from other issues. So it's broad-based. When you look at the consumption basket, you're seeing those inflationary pressures throughout. So that's why we wouldn't just point at oil as, potentially falling and solving this matter. For us, it's still a background where we have much higher inflation than we're accustomed to. Yeah. And it's too early to say that that's behind us.
Rob, final word on the influence of oil variations and fluctuations on the level of bond yields.
I think the driver for both bond yields and oil is this decline we're seeing in growth expectations. As oil comes out of as oil prices come down, that does, I think, feed into break-evens, like Ella said, which gives us some relief overall. But we still have very high real yields in a recent historical sense, and that's due to the Fed. So there's only so much, the break-evens can do.
Rob Waldner, Ella Hoxha, thank you both so much for being with us today, and have a wonderful weekend. Coming up, the morning calls, and later, FedEx alleviating Wall Street's corporate profit concerns. That conversation still ahead with Federated's Phil Orlando. The opening bell is coming up, and perhaps we will snap 3 weeks of straight losses with a fourth one of gains. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Farrow. Let's take a quick look at the markets. They are extending gains ahead of the open. The Nasdaq up 1%. S&P futures up 0.9%. How much is this being underpinned by what we've seen in 2-year yields so far over the past couple of months? A huge surge in yields, about a percentage point over about a month, and then absolute whipsaw downward, about 50 basis points in a week. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley upgrading Altria to equal weight, $43 price target, seeing a more balanced risk reward following recent declines. Next up, Citi downgrading Hess to neutral, $110 price target, expecting economic headwinds to keep a lid on energy stocks. And finally, RBC Capital cutting its Meta price target down to $200, pointing to weakening trends emerging in ad spending. Coming up, futures pointing to more gains as stocks look to snap a 3-week losing skid. That conversation coming up next with Federated's Phil Orlando. The opening bell is up next. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Farrow. Moments away from the start of trading, possibly the first up week in 4, with the Nasdaq leading the way up nearly a percentage point, up 0.9%. The Russell up 0.8%. The S&P 38.31, about 0.8% gain. You're seeing the bid into yields, so the bid into bonds, really take a step back as we do see a bit of that classic risk on kind of feel, and we see the euro asserting itself over the dollar. Crude getting a bit of a lift today as recession fears fade. Right now, let's take a look at some of the stocks moving at the opening bell. Here's Abigail Doolittle.
Well, Lisa, with the S&P 500 poised for that first up week in 4, as you were just mentioning, lots of participation from lots of the big stocks. Starting out with the shares of Apple. Apple is on pace to climb 6% this week, the best week, not surprisingly, since the end of May, up about 1.2% as investors start to embrace tech once again, thinking that maybe yields have peaked. Let's see about that. But that, of course, takes off valuation concerns. Now, yields peaking, not great for the banks, but Morgan Stanley up 1.7%. Of course, the big banks passed the Fed stress test with flying colors. I believe Shanali will be talking about that in just a little bit. Morgan Stanley, I think the best of those tests. FedEx up 3.9%, very strong quarter. They lifted the outlook on rising freight prices, so managing rising costs and supply chain issues quite well. And then finally, take a look at Zendesk. The billion customer support company is now roughly an $11 billion customer support software company. This on a buyout from a group of private investors for $9.5 billion, Lisa.
Abigail, thank you so much. This week's bid into bonds providing some relief for big tech stocks. Let's bring in Kaylee Lyons for more. Kaylee.
Well, Lisa, I feel like I have to preface everything I'm about to say with some context, because while this week has been more positive, it has been absolutely brutal for tech this year. The NASDAQ 100 is still down about 28% year to date, at least as of yesterday's close. And of course, we've seen an immense amount of selling pressure in the bond market as well, with the 10-year yield up 150 basis points since the start of the year, which is a large part of the reason why tech has been down so much. But it has been a very different story this week, as we've seen the 10-year yield coming in about 13 basis points on the week. We've seen the NASDAQ 100 rally about 5 percentage points on the week. And you can see the money coming back into tech reflected in the flows as well, and that we've seen more than $1 billion collectively of inflows into the Qs and the Vanguard Tech ETF. At the same time, take a look at where the outflows have been. Yes, the broad market, the S&P 500, SPY, which tracks it, but also value and Russell 2000 stocks, more cyclical, value-oriented areas of the market, which really speaks to the kind of defensive tilt we are seeing as people talk more and more about, yes, the R word, the chances of a recession. And that defensiveness has also been reflected into the bid we've seen in bonds. And I would like to just say to anyone out there who has been talking about the death of the 60-40 portfolio, it came back to life this week. We are looking potentially at the third 1% plus gain for 60-40 so far this year, Lisa.
Kaylee Lyons, thank you so much. Out of tech and into safety, just following on to the theme that Kaylee was just talking about, here's Taylor Riggs with more on that defensive tilt. Taylor.
And certainly a little bit in terms of what the market, Lisa, is starting to price in. You take a look at defensive stocks relative to the MSCI World Index and sort of that relative value, that comparative ratio. You certainly are starting to see defensive outperform a little bit, though we were joking yesterday on the close. If you've Clorox, Procter & Gamble, and Kimberly-Clark all up at least 2.5% yesterday, that doesn't feel like a good thing. Romaine's already been hoarding my toilet paper in March of 2020. I certainly do not want to go back to that. Let's talk, though, about some of the recessionary times and that's sort of what the market's pricing in. When you think about underperformance of the stocks, of the commodities, of the financials underperforming the market, at least in the last month, that's sort of where you start to get a little bit worried about sort of the broader economics. We talked a lot about copper and oil, for example, on our program in the afternoon. I think what is interesting, though, when we take a look at sort of the flows, and Kaylee was sort of mentioning this, right? The outflows and the going back into cash. What is that telling you? Global equity funds did see the biggest outflows in 9 weeks. Investors are going back into cash. Now, as you know, after inflation, is cash trash or is cash king?
Taylor Riggs, thank you. Definitely varied opinions on that. Right now, we are hearing about St. Louis Fed President Jim Bullard, his latest comments out of Zurich, where he is speaking at a UBS conference saying, I actually think we will be fine and that recession concerns are overblown. Joining us now, Phil Orlando of Federated Hermes. Do you agree, Phil, that so far recession calls have been a bit overblown?
Well, you take a look at benchmark 10-year Treasury yields just in the last fortnight. We were at 3.5%, I think, last Wednesday. This morning, we're sitting here at 3.1%. So you ask yourself, how is it possible that the bond market could have rallied so much in the space of, 2-week period? I think the answer is the bond vigilantes firmly believe that if we're not in a recession now, we're grinding towards one over the course of the next year or two. So professional investors are thinking that recession is probably inevitable.
Do you think that this is an opportunity in order to go back into big tech, which is something that we did see this week?
No, that's premature. That we've had, a bounce in equities over the course of the last week. No question about that. But I think that's more of an oversold bounce. You look at the data we're looking at. We're going to get an update on Michigan sentiment at 10 o'clock. That number's sitting at a record low. The savings rate sitting at a 14-year low. Inflation sitting at a 40-year high. And let me bring in a data point from yesterday. The initial weekly jobless claims. Yesterday was the survey week for the June jobs report that we're going to see in 2 weeks. Initial weekly jobless claims are up by 38% over the course of the last 3 months. So I think we are looking at a deceleration in economic growth, yet the Federal Reserve, having given us a 50 basis point hike in May, a 3/4 point hike in June, I think we're going to get another 75 basis point hike in July. And then that takes us to Jackson Hole. The Federal Reserve, I think, is going to be very data dependent. I think that Jay Powell would love to get up to the podium and declare victory, that we've seen a peak in inflation, that the Fed will begin to start to downshift to a series of 50s starting with the September FOMC meeting. But we haven't seen any evidence yet that inflation has in fact peaked. We think it will peak at some point over the next couple of months, but I think we're basically in a wait and see mode. Our models, our dashboards are suggesting an increased risk of recession somewhere in that mid-24 period. But given the accelerated pace at which the Fed is tightening policy here, maybe that recession risk should push forward into early 24 or late 23.
Yeah.
So I don't think we can declare victory on the recession question just yet.
Before we move on to the next phase of looking at banks and some of the specific sectors, Credit Suisse has been looking at mixed signals in the equity market. I'd love to get your thoughts. Breadth of the sell-off and implied correlations bullish, this according to Credit Suisse, but earnings revisions and positioning are bearish. Equity is seeing consistent inflows despite depressed sentiment. This supports our thesis of fully invested bears. Given your bearishness, Phil, when you talk about the potential pain ahead and the fact that recession may not be overpriced in markets right now, what's the low end of your S&P call at this point? At what point do you start to feel like things are bottoming out?
So we're sitting at about 3,800 on the S&P 500 right now, but our best guess is that the second quarter earnings season is going to be very challenging. Our best guess is that we are going to be looking at a 3,500 S&P 500 at some point in the late August to early October period. If we could get the market down to 3,500 over the next couple of months and then begin to intellectually price in peak inflation, peak Fed, peak negative earnings comparisons, then I think we might start to get more comfortable looking ahead into the fourth quarter to begin to put, dip that toe back into the water.
One sector that's been really beaten up has been the banks. The Fed out with the results of its annual bank stress test. Bloomberg Sonali Basak joins us now for more. Not exactly as stressed as their stock share price, has it been?
Not exactly as stressed. Of course, all the more than 30 banks had passed the stress test, Lisa, but the devil here is always in the detail. When you look at how much the excess capital was left over after the stress test, that number was, that percentage was worse than last year. Remember, a 2.7 percentage point decline in the aggregate CET1 ratio is larger than what you saw last year. Part of that is because the provisions for loan losses this time around were lighter, and credit cards and commercial real estate collectively has a 16% projected loss rate in this stress test and an almost 10% projected loss rate in commercial real estate. So that will affect the regional banks more. You also have Jefferies expecting that Bank of America, Citigroup, JP Morgan may also have to raise their internal target ratios, which would mean less room for buybacks moving forward. But the question here is, what does that really look like moving forward? We already know the banks have already guided towards less capital return to some degree, but for different reasons than what we're seeing in the stress test. You have JP Morgan talking about a preference towards acquisitions. You have Goldman Sachs also talking about putting money back into the business and getting higher ROEs that way. And you have Citigroup also guiding for a tougher macro environment ahead. There are a lot of reasons to have muted expectations for buybacks, but that tension, Lisa, will always exist between whether the banks give that money back to their investors or choose to lend it in this rising interest rate environment when lawmakers and the country may want them to be lending.
Sonali Basak, thank you so much. RBC's Gerard Cassidy weighing in after all the major U.S. banks passed their stress tests, writing, quote, "The results reinforce our conviction that the capital position of the largest U.S. banks remains strong, and they will weather a recession significantly better than the 2008-2009 recession." He went on to say in a conversation with us this morning that investors still had too much of the memory of 08-09 and were not valuing some of these banks properly. Phil Orlando, still with us. Phil, do you agree?
Absolutely. I think Gerald and Sonali are both spot on here. We've got a value bias, a defensive bias at Federated Hermes, but banks, financial services are one of the areas that we like. We've got a buy on financial services as well as energy, healthcare, and materials. So we think that that financial stocks are significantly undervalued relative to their prospects. We think the balance sheets are in great shape. The financials are being well managed. So I think with as cheap as they are, that's a place to be aggressive here.
Phil, with respect to which banks, are you looking more at the investment banking or are you looking more at the traditional lending?
Above my pay grade. I'm more in the macro area, but certainly a J.P. Morgan, for example, we think touches upon all of those different areas, well capitalized, well managed, and the stock is cheap.
Phil, when you talk about defensives, at what point do they become overpriced, and do you start looking at some of the consumer cyclicals again, considering that we will be entering a new phase at some point of recovery?
I don't think the market has fully priced in how challenging second quarter earnings are. And I think I would be much more interested in seeing A, how bad are those earnings, B, how bad is the guidance, and C, where does the stock market bottom out post second quarter earnings against a very challenging 88% increase year-on-year comparison, second quarter of 21 versus the second quarter of 20. I don't think the market has fully priced in exactly how difficult the second quarter earnings are post that earnings season, and that would take us, into mid to late August. That would be a period that we'd sift through the rubble and see what valuations look like.
Phil Orlando is sticking with us. Coming up, Wall Street paying close attention to corporate profits, as Phil was talking about, amid growing recession concerns.
You're going to have to look at each company and see how they're handling the labor and the wage cost and the fuel cost that they're facing now.
That conversation coming up next, and it does look like we are building on some of the gains that we experienced throughout the previous 3 days. The S&P now up 1.3%, extending gains. If it finishes in the green, we are looking at the first weekly gain in 4 weeks. From New York, this is Bloomberg.
FedEx actually had increasing margins on some of their freight, which was interesting. They're increasing their fuel surcharges. And so I think you're going to have to look at each company and see how they're handling the labor and the wage cost and the fuel cost that they're facing now.
That was Crossmark's Victoria Fernandez. FedEx overcoming rising rates and labor shortages by boosting packaging prices. This is growing recession fears of Wall Street increasingly concerned about corporate America delivering unlofty profit estimates.
If you have a crack in the earnings story, well, then the multiples are really going to get beaten up in valuations. Let's say they're 15, 16 now on the market, something like that. They can get down to a multiple of 12 or 13, and that means that we have a lot more pain to go if there's a real grown-up recession that's going to happen.
Bloomberg's Taylor Riggs joining us now with more.
And I like that you tied in both Victoria and Jonathan Golub there. Let me start with Victoria's comments. When we think about FedEx, yes, indeed. I mean, you have a relatively new CEO who's been on the job for a couple weeks, really seen full year 2023 bottom line higher than expected, and coming out in that press release and seeing that they are on track to meet those, and also saying that those 23 margins are going to be rising at ground, express, and freight. And that's really what analysts want, Lisa, right? We don't care about the last quarter. We really wanted to see strong performance on that forward guidance. The market likes it. We had that great interview with Jonathan Golub yesterday as well. And I think it's interesting to point out that he is not seeing those signs of the cracks, which is why if you take a look at the terminal chart, those estimates are actually hanging in there. And he actually thinks that that actually could be reasonable. Maybe that isn't too lofty. When you think about the dispersion, when you think about bankruptcies versus widening CDX spreads, all of those signals that he's looking at, he doesn't see a massive recession on the horizon. And that is why maybe in part some of those earnings guidance and those analyst estimates aren't actually moving a lot lower here. Take a look, though, at growth estimates, and indeed profit growth estimates are rising. This is, again, sort of good sign from the street, showing that some of these individual companies can weather some of the inflationary pressures, and indeed, Lisa, pass those on to the consumer.
Taylor Riggs, thank you so much. Following margin pressure, Mundi's head of equities saying, quote, the shoe to drop will be on margins. Companies are still very confident, but the market haven't seen these clouds. You can't have these three clouds of runaway inflation, soaring commodity prices, and supply chain snafus without having some kind of rain. Phil Orlando of Federated Hermes is still with us. And you were talking about how you would agree with that. We were talking about margin pressures and how that's not fully priced in earlier. Do you still think that the U.S. is the best place, or do you think that the U.S. is going to experience more significant, unexpected margin pressures than other areas that have been more beaten up?
No, I think we're certainly looking at U.S. margin pressures based upon increased wage costs, commodity costs, transportation costs. That's going to manifest itself in I think, difficult second quarter earnings, and we're likely to see some guidance down from some company managements for the back half of this year. Now, international, to some degree, has priced some of this in. International stocks right now are about 40% cheaper than domestic stocks. So if you've got I guess a long enough time horizon, and if you can sort of look through the energy problems that the UK and the Eurozone are having with regard to oil and natural gas coming out of Russia, then the valuations in Europe right now are relatively attractive. But I think the margin pressure story is not a U.S. story specifically. I mean, it's one that we're seeing globally. Everyone is having the same problems.
Are there particular industries, Phil, that you're seeing more likely to come under margin pressures that are not priced in sufficiently yet?
You know, I'll give the example of Target, the big retailer that's profit warned twice over the course of the last couple of months. And they talked about slowing economic growth, slowing margins, inventory problems. You know, they took their estimates down. And the pushback that we've been getting from clients, Lisa, is that, well, it's Target, it's a one-off. And our argument has been, no, Target's a really well-managed company. It's probably not a one-off. They're probably the only company or one of the few companies that has either figured out the problem, number one, or number two, is brave enough to come forward, you know, when they did, to talk about some of the issues. I think that virtually every company in America is going to be experiencing the same problems in the second quarter, and we're not going to get that final report card until they start reporting from the middle of July into the middle of August. So given the fact that you've got an 88% year-on-year comparison in the second quarter of 21 versus the second quarter of 20, I think the second quarter profit season coming up over the next couple of weeks is going to be very difficult.
Yeah.
And you know, given this dead cat bounce we're seeing this week, I'm not sure investors are looking that far ahead.
And perhaps not individual stock analysts either. And it's a question because we saw Patrick Palfrey over at Credit Suisse really highlighting how the fundamentals have not had a confirmation of some of the skepticism of the earnings season, saying, quote, people are calling for a decline in earnings, but we're not seeing it. They're interpreting the sell-off in the marketplace as a foreshadowing of an economic and corporate profit crisis, but we're not seeing it in the fundamental data. Phil, who do you think is wrong? The individual analysts who are actually looking at balance sheets and that perhaps they just don't have the visibility, or markets that perhaps have priced in a widespread earnings compression that perhaps may be more nuanced?
Look, I think the work that John Golub and Patrick do over at Credit Suisse is exceptionally strong. They do a terrific job. I think managements are going to have a come to Jesus moment a month from now and provide us, the Wall Street, with the sort of guidance that we're looking for in terms of visibility. We don't have a lot of visibility right now. And the markets, I think, were correct up until about a week ago. But as you pointed out, we've got this very strong counter trend rally here over the last week. That's fine. We were oversold a week ago. The market could rally for another week or two. But I think when we start to get some hard data and some hard guidance starting in the middle of July, I think the market will sort of retrace where we were, get back to that 3,800 level, and possibly plumb lower down to that 3,500 level as the market, the street, has some better data and can price that in.
Phil Orlando of Federated Hermes, thank you so much for being with us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, we are seeing a rally to end the week. The rally extending out quite significantly, with the Nasdaq up 2.1%, the S&P up 1.5%, 38.52. And you can see bonds getting sold off just a bit, but a real calm and constructive tone to end the week. This is Bloomberg. This is Bloomberg markets at the open, a strong rally to end the week. At least if this holds, we've got a 2% rally in the Nasdaq, a 1.5% gain on the S&P, possibly the first week of gains in 4 weeks. Time now for the trading diary, what you need to be watching for the next week. The University of Michigan Consumer Sentiment Survey coming at the top of the hour. President Biden traveling to Germany for the G7 summit on Saturday. The president then heading to Spain on Tuesday for the NATO summit. Plus, Fed speak from President Mary Daly. And finally, central banking heads, including Powell, Lagarde, and Bailey, gathering in Sintra, Portugal on Wednesday. This was a countdown to the open from New York. This is Bloomberg.